Good afternoon, everyone. Happy Friday. Gabe Velazquez here with you, transparenttrading-solutions.com. Hope everybody had a great trading week. It's been a little bit challenging. Hi, Trina. How you doing? Long time no see. Wow, right? It's been several years now. So glad to see you in here. Yep. Okay, everybody. So let's get right into it. The themes I want to cover today, very important for your edification. Obviously, I did a session actually yesterday, finding an edge and understanding how the markets work and so forth. But the two main themes today, and primarily the dollar. Let's talk about that. The U.S. dollar was probably one of the main drivers that caused the stocks to go down. So if you guys have been watching me, I've been doing these now, gosh, it'd be 3 weeks now. I started come in on a Friday and on a Tuesday. And, I've been pretty much discussing we've had this huge rally coming up into, some distribution, VIX under 20, with seasonals coming in weaker and so forth. And if you've been, by the way, there are some links on the bottom there. If you are not a newsletter subscriber, go ahead and subscribe to the newsletter. I've been, I actually can point to a few things that really have worked out for some people if you were reading that on the weekends. Also, if you want to contact me directly, you can do that via the contact web link below, and also through transparenttrading-solutions.com. That's my website. That's my email from there. Okay. All right. So with all that out of the way, yeah, the dollar. So let's think about there are two main drivers, and the dollar. If you understand what the dollar rallying, why did that's kind of kind of a headwind for stocks, because a stronger dollar actually hurts most of the big cap, mega cap, multinationals. That's part of it. Also, what's driving the dollar higher is interest rates. So it's all kind of correlated, right? So higher interest rates, if you watch the bond market this week, I've been talking about that. The 10-year in particular, if you want to focus on one particular maturity, that's the 10-year note. That's because everybody's looking at that. And if you look at the charts on that, we did have a big sell-off, and I did allude to that on Tuesday. I basically told everybody, look, watch the bond market. And if the rates continue higher, the NASDAQ in particular is the most sensitive of the indexes to higher interest rates. And you saw that today. You saw that with, the NASDAQ falling off. Incidentally, I gave everybody a level. I mentioned this in the Twitter. If you've been watching, I gave everybody a level 13,700 to 13. What was that? I think I actually mentioned that. So, if you pull up your charts, you actually can see that on your charts. And one of the things I encourage you to do while you're watching is have your charts up, because what I'll do is I'll give you some areas that you can look at yourself. And again, rather than I can put all, I can show you my charts and all that, which I do in my free classes and so forth. And if you, but I think it's more educational for you yourself to actually, when I give you some areas to look at, that you actually see those for yourself on your particular charts, right? So if you look at 13,775, 13,788.25, that's a level I've been giving out for two previous sessions. You'll see that clearly was a level where the NASDAQ turned down from. And And that is, if we do rally back up again, then there's another level on higher than that. But if you were paying attention and again, possibly got into maybe some short QQQ puts, maybe went long QQQ puts, maybe went long QQQ puts, or basically sold some calls against some of your tech holdings, which I did write about that in the newsletter this last weekend. I basically encouraged everybody, if you're long, write some calls or get a little bit more defensive. So where are we at now? So that's obviously, we've fallen off. The debate now still is whether this is just another bear market rally and essentially we fall off the cliff again here and go all the way back down and test the June lows, or is this the bulls will tell you that this is just another pullback, or pull back, and we kind of head higher. And again, as you know, I'm not really big on labeling markets, because what happens is when you start labeling markets, whether it's a bear market or a bull market, whatever, it kind of clouds your judgment. And I made this comment, I think it was Tuesday, where rather than do that, if you subscribe to, oh, this is just a bear market, then you've just essentially moved, basically did not participate in a huge rally from the bottom, which coincidentally or incidentally was a monthly accumulation in the S&P, right? And again, I did write about that, and I basically, and so my point to you is that if you go to that conventional thinking, you're going to miss out on some really good moves, even if the market is in a bear market. And in fact, the biggest rallies happen in bear markets. And so buying low and selling high is what I preach, right? Buying low and selling high. So now that the market's rallied all the way up, to these distribution levels, now this is when you should be shorting. Does that make sense? So I've kind of full circle. I was actually encouraging everybody to be long in June, if you recall, right? If you were reading my newsletter, whatever, that's when you want to be buyers. And now that we've come full circle, now, it's interesting because, you get people telling you, it's interesting to me, because if you watch media or conventional technical analysis, they have to cross over the 200-day moving average. Well, think about that. That means that the S&P will rally 20% and then you get comfortable buying, right? Go figure that one out. I've never been able to figure that one out, but that's the way it is. Now, that doesn't mean the market, could take off from here, but I mean, risk to reward doesn't make a lot of sense. But in any event, yeah, Trina, let's see. Would you call the upper level for 128, 4208? No, that's actually a little bit lower than that, Trina. Yep. Let's see. I'm sorry. Yeah, no, I have a level lower than that. Yeah. So, yeah. See if you can figure that one out, right? Yeah, these are the levels I put out for my members pretty much every, we go through our session every day. But in any event, so where are we at now? If you are, again, when the markets come up this much, I want to buy a deeper pullback, right? So just like I talk, I use these terms like if the market's been selling off pretty sharply coming into some high time frame accumulation, you don't want to short it. Even though you have, possible supply levels or whatever, like, I call it like deep in the hole, right? Because that usually doesn't work out. That's a poor location. Does that make sense? Well, the same thing happens when you rally and you try to buy any small time frame accumulation areas where you're going to get whacked, like you probably have gotten whacked over the last week trying to buy any pullbacks. Make sense? I mean, you might have got a little bit, I don't trade for, bits and pennies or whatever. I'm usually trying to go for the bigger moves, as you guys know. So, um, but so where we're at right now, if indeed this is just a pullback, where do you buy the pullbacks? Well, on the S&P, I'm really not interested, and that doesn't mean that the market, I could be off and the market could just take off again. There's a whole bunch of levels, and again, I don't sit here and give you, or talk to, give my members like 20 different levels, and then point out to the ones that worked. Right? You know what I'm talking about, right? Yeah, I gave you 20 levels, but here's the one that worked. Oh, okay, nice. Good job, right? Um, in fact, I would probably go all the way back down to maybe in the 4,100 area if I was really going to take another stab at the long side of this market. Again, that's not to say that it can't bounce from higher levels, but for me, just kind of looking at that. Yeah, exactly, Dennis. Yep, you know what I'm talking about. So yeah, so I would look down in the low 4,100s. There's a couple of really nice levels down there, and in fact, we had some nice levels forming in the shorter term of distribution in the last couple of days, right? And so that's kind of where we stand at TTS, right? We're going to buy some deep pullbacks, and hopefully we get a bounce. But again, the dollar is a problem right now, right? So going back to the dollar seems to me poised to take out that high of 109.28. If you look at your dollar index chart. And part of the reason why the market sold off was the dollar rage today. And that, we'll get into currencies in a second because that's really important. So if you were paying attention, I did mention that the dollar looked poised to go up on Tuesday. And that would be essentially a headwind for stocks, that coupled with interest rates. And so be careful with that. If the dollar continues to rally, it's going to continue to pressure stocks. And if you look at your now on the dollar DXY, go out to your monthly charts. Now you have to go really, because, these are kind of, 2008, I think was the last time we were up at these levels in the dollar index. Yep. Yeah. Par is where, yeah. Just touch monthly demand. That would suggest. Dennis, I would watch the par. I would on the future side, because I don't trade FX, as you know. I don't trade the spot FX market. I would look at that par. $1 to $1. That would be where. And I do suspect it's actually going to break par, the euro against the dollar, right? So that would be the one. If you look at your charts, that would be one on the euro. Okay. But the prior high is 109.28. Now, I do suspect we will probably make a new high in the dollar. And the question now is, where would you see a pullback? Based on that chart, I don't have any level on the dollar until about 110.73 on a monthly basis, right? Does that make sense? Well, Dennis, it depends on how you look at the futures chart, right? So, but I only look at the dollar index. Actually, the dollar index is, the king dollar is everything, if you remember my teachings, whatever, right? And why is that important? Because if you think about what happened, yeah, hi, Robert. If you think about what happened to the metals today, silver in particular, right? Look at all the currencies. Not to some degree or another, the two most sensitive currencies in the futures side, because it's dollar, they're dollar pegged against the dollar on the future side makes it super simple, is the yen and the euro. But that's because they're the two biggest pieces of the dollar index, right? And remember, I've been talking quite a bit about the yen. Well, it looks to me like the yen um, is actually going to break to another new low. It just and we actually were looking at some accumulation levels on the yen, but I backed off of that because of the dollar. And now, if you look at the chart of the yen futures, looks like the yen is actually going to make another new low. So buying the yen is off the table for us at TTS right now. We're just not going to be looking to buy the yen until we actually see those buyers come in, just like we had a couple of nice buys and have a lot of action in the yen prior to this huge move in the dollar, which was really nice to trade. We went long, short. I mean, if you look at that yen, and that's why Kyle was focusing on that. But now that the dollar has surged and we've broken pretty much close to a new low in the yen, that comes off the table. Does that make sense, everybody? So for until we get new evidence of buyers coming into the yen, there's nothing to do on the yen. And even shorting, you have to wait for a bounce back up to on the yen. I'm looking at, a bounce possibly all the way up. There's a whole bunch of levels now, distribution levels on the yen. Up around the 74 and higher than that. Okay, does that make sense? So, but some of you guys may be looking at the yen and saying, well, isn't there accumulation somewhere down around 72? Well, that's not really that great. And again, if you're trying to buy the yen down in here, that obviously, you have to understand how this works. Dollar raging higher, doesn't matter how great demand zone in any of the currencies looks right now, you're going to get whacked, right? Does that make sense? So again, if you go through all your currencies, now again, to some degree, there are, for instance, like Canada, relative to its low, that's still hanging in there. The peso, I've been talking about the Mexican peso, that's also hanging in there pretty tough. These are com dolls. All the com dolls are actually doing better. But if you take a look at like the British pound, that looks like it's breaking 118. The euro we've already mentioned, that's probably headed to par. And the yen, we've already talked about that. So that's kind of where we're at. And then also to kind of extend that discussion, the silver broke 19. Gold looks like it's headed back down to 1740-ish. And again, this is related to the dollar. So today was interesting because if you were watching silver, that actually broke hard and it actually had a lot more weakness than gold. And, part of it is because silver is actually an industrial metal now that's used in solar and all kinds of stuff and chips and that type of thing. Whereas gold is still kind of, you could say it's also kind of in some of the other stuff, but not as much as platinum or palladium or even copper. Obviously, the copper hasn't really done a whole lot. That's why I haven't really discussed that. Does that make sense? So to kind of sum this up, stocks are still kind of in that transition phase. I'm still a little bit more leaning towards shorting the indexes, and possibly even selling bonds still, right? No, there's some other there's a little bit of an industrial use for gold, Dennis, but not as prevalent as silver or the obvious ones, copper and platinum. Okay. All right. So this is all tied together. This is how we're going to wrap this discussion. I got about 10 minutes, right? All of these markets are driving, and I would tell you, and you've heard me say this in the last couple of weeks, interest rates are driving the stock market. So in other words, if you, again, put that chart of the 10-year against your NASDAQ or the S&P, you can clearly see the inverse correlation, and or direct correlation, I should say. In the old days, bonds would go up and stocks would go down because bonds were the safe haven, but not in this environment because we got a tight Fed, we got a less accommodative Fed, we got and so now they're almost kind of trading in sync, right? And so and it's due to interest rates. So you remember, bond prices go down, rates go up, and that's the whole premise here why stocks can't get going if rates are coming up, money is getting more expensive, and so on and so forth. Okay, and then inflation obviously is the big driver as well of all this. And so tying it all together, going next week, and we got Jackson Hole next week. So I'll be on Tuesday. We'll talk about that. It's not until the end of the week where there's obviously going to be a lot more kind of Fed watching and kind of extrapolating what they say. Every word's going to be, trying to figure out what they mean and so on and so forth. So that's going to be really, again, another kind of interesting situation. Yep. And it will move the markets. And with the thin markets the way they are, that's why you're seeing some of these moves, because the market's been kind of thin, driven by algorithms for the most part. Okay, so that kind of sets up for next week, tail end of the week, as again maybe more volatility, and then we're going to get into the volume coming back on after Labor Day, and then get into that seasonal bad period, if you will, in September. So everything's setting up. Yep. With the curve inverted, does that mean stocks will keep going down? Well, the inversion of the curve, yeah, you've heard. Where'd you hear that one, Marius? Where'd you hear that one? You haven't been watching my tweets. Yeah, it's interesting, right? So Robert or Bob, yeah, the inverted yield, that's a whole different discussion. I don't have time to get into that right now. But in a nutshell, when you have long-term rates below short-term rates, that is predictive of a recession, probably 90% of the time. The only question is when does the recession come? So obviously we know that things are tough right now with inflation and more layoffs coming and so on. So again, that's a whole different. I really don't want to get into that. That we're traders here, right? But what I would focus on, Robert, if you're a trader, is the relationship between bonds, the dollar, and stocks. That's kind of what I would focus on. That's kind of a macro thing. Recession's coming, everybody. I mean, that's a given. It's just, yeah, it just depends. And the other thing, since we're on this topic, is they're going to start really tightening on September 1. They're going to actually really start buying back some bonds and so on and so forth. So that's also going to tighten up monetary conditions. And again, the next question would be how is that going to filter through the economy, right? That's really the big thing. How is that? Is that going to be a positive or a negative? And clearly, it's not going to be a positive. So, in any event, all right. So let's finish up. I've got about 5 minutes, everybody. Oil, again, another big driver. I've been talking about getting a little bit warming up to oil. I've been very bullish on that gas, as you guys know, because of fundamentals, and it still, to me, looks like nat gas is poised to take out that 965 high. And again, go look at your charts, monthly charts of nat gas. We've been as high as 13 and 15 back in the early 2000s in nat gas. That was when we had ample nat gas, and then the fracking and so forth. But in any event, so I would still be buying pullbacks in nat gas using UNG or whatever. Oil, very erratic trading, but it is holding that $85 mark. And what it's basically the pattern for oil over the last several months, literally since the beginning of the year when the incursion of Russia into Ukraine has been, it kind of goes into a range, right? It sets up a range. First, it was like 115 to 125, and then remember, and then it went down to like it was like 105 to 115, and so on and so forth. Now the new range for me looks like is 85 to like 92. If we do break above 92, I think we got a shot at 100. And I ultimately believe that oil is probably headed back up over 100, tight supply, and so on and so forth. So on a short-term trading basis, I think you still want to look at it as a kind of trading range. Everybody got super bearish on it when it broke 90, and you saw it rallied all the way back about $7 above. But it kind of been, I mean, there's some levels in there that we've been checking out, distribution levels on oil, and they've worked for about 2 to 1. But you'll notice that the pullbacks are getting shallower on oil, which again, anytime you get a shallow pullback relative to the prior pullbacks, that is a signal that perhaps buyers are stepping in as well. So I would, and again, we're looking at USO. I think I mentioned that TTS. We are looking to buy some calls on USO. Look at that chart. That looks pretty interesting. If oil is in the low 80s, that it's kind of a tricky thing with USO because they keep rolling contracts and so forth. So, but you can clearly see a pretty clear-cut range in USO, and we are now towards the lower, kind of lower band of that range as well. Okay. And then that gas we just talked about. Then lastly, the grains, obviously another big inflation piece. One of the things that caused the inflation scare earlier this year was, wheat, and pretty much they had these massive rallies in the grain markets. Those have come off considerably. Wheat in particular just crashed literally from 14 a bushel down to, I think 7 is probably the floor on wheat. Looking at 7 as the floor on wheat. Beans $13.50 and corn around $6. Again, if you don't trade the grain markets, I encourage you to look at those, obviously at your own discretion. I'm not making any recommendations. There are some mini contracts, 1,000 bushel contracts versus 5,000 bushel contracts. There's also, I don't know if you guys are aware, there's WEAT, wheat ETF. There's actually ETFs, corn, CORN, that's a corn ETF. And then there's actually, there's also a ETF for soybeans, and the ticker escapes me right now. But you can also look at that from a longer term perspective. Okay. Yeah, I think that sums it up. Any last questions before I get out of here for the weekend? Hope everybody has a great weekend. Again, go down to the links if you want to ask me any questions. Reach out to me via my email. Also on Twitter, you can private message me, and so on and so forth. So hope everybody has a great weekend. Next week, again, interesting to see if we can get some follow through to the downside. Other than that, have a great weekend, everybody. And remember, I'll be back on Tuesday, and subscribe to the channel. Subscribe to the channel so you can get the notification, but just keep it on your calendar. Tuesdays and Fridays, I'm going to be pretty consistent with that. Okay. All right, everybody, have a great weekend, and I'll see you on Tuesday. Take care.